Hi, everybody. Jenny Ifft. I'm the Fungible Agricultural Policy Chair here in the Ag Econ Department at K-State. I've been here for over 3.5 years now. And my focus on the extension side has been on options for livestock producers, as well as some of the newer options in the crop side, including SCO, the Supplemental Coverage Option, and some other higher coverage policies like the Enhanced Coverage Option. I do have quite a bit of material here. I think, some of these policies have been around for a while, so I assume most of you are inexperienced. So I'm going to really be going over the main points. There's some new studies and some resources I'm going to share that I can take questions about, follow up with, resources that are available to help support producers to make these decisions. But I am going to just go over the basics of SCO first, talk about key considerations before I get into how SCO might play a role in the ARC versus PLC decision. So first of all, SCO, it increases your coverage, underlying coverage, up to 86% on a yield or revenue policy using a county-based trigger. A related policy is the enhanced coverage option. I'm not going to be talking about this too much, but it is going to come up again in the conclusion. It is relevant here. And this takes you from above SCO, so from above that 86% up to 90 or 95%. And you don't have to use SCO with it, and you can use it with ARC. So potentially a tool some producers might be interested in. Now, in this chart, here is a visual for what SCO does. So let's say you have an underlying revenue protection policy, the 70% coverage level. SCO takes you up to 86%. And that guarantee is going to be based on your guarantee, but the trigger is based on the county. And that has to do, it was set in the Farm Bill, but generally with these higher coverage policies, they're going to have a county-based trigger due to moral hazard issues, and they would be even more expensive if there wasn't that county-based trigger. You can use ECO, the enhanced coverage option, with or without SCO. So again, it's protecting more revenue. SCOU supplemental coverage option, it's still fairly limited in Kansas, but it has been growing. So for our major crops today, it's about 5 to 7% of all acres. Couple different reasons for this. It's a new product. There's a learning curve. It is going to cost more. You have to pay in as compared to ARC, which is free. Producers might also use other types of risk management. But again, this chart shows where we were in 2015 and a steady upward trend for all crops through 2023. I do want to look at the loss ratios, especially for 2022 is a devastating year in a lot of counties in terms of the yields. So these are the years when SCO and even the underlying policy should really trigger out and provide protection when that protection is really needed. So I did a county map of 2022 loss ratios. This also gives you an idea of participation. So the counties in gray didn't have any acres enrolled. Everything else had some acres enrolled. So we see for corn, this is a combined loss ratio. So all coverage levels, all irrigated, non-irrigated practices, everything. The payouts, loss ratios, or the payouts much higher in the Northwest, Southwest there, as well as the Southeast where there is a extreme drought. Soybeans, not much soybeans enrolled in Western Kansas, but where they were, they paid out quite a bit. Also a lot of enrollment and high loss ratios in the eastern half of the state for soybeans. For sorghum, a lot of counties didn't enroll any sorghum in SCO, but for those that did, the payouts, indemnities in 2022 tended to be high, especially in Southwest Kansas and throughout Central Kansas. And last, wheat. So again, some counties don't use SCO for wheat. And if you go back to 2020, those drought, for a lot of the state, the drought conditions really didn't kick in until the spring or late summer. So, you do see those payments in the Southwest where it was already dry then, but not necessarily in the rest of the state. So there's a couple key considerations when a producer is thinking about SEO. It really is a different and more intensive way to manage risk. So there's some things you have to be aware of. It's not gonna always work like the underlying the revenue protection policies that are the norm now. So first of all, it's going to cost more. It's going to pay out more on average. It's a typical experience. It is county level. That's something you need to be comfortable with. And it could potentially might not match farm level loss. And I'd also say a long-term perspective is important. I'm going to go through each of these. First of all, I'm going to get the costs out of the way. So I have two counties where I'm using for my examples. First is irrigated corn in Finney County. I'm using an APH approved yield that's about at the county level average. I'm using current harvest futures prices. Now these are still in discovery, and then my soybeans example, that's Nemaha County, non-irrigated, same parameters. So if you look at these, I have these are the producer premiums here for an underlying revenue protection at 75 at different coverage levels, as well as the SCO policy on top of that. So two big points here. If you look, couple big points. First of all, that increase in premium going to be pretty substantial. Whether you're doing irrigated corn in Finney or in the soybeans example. Now, if you sum up revenue protection plus SCO, it's not that different. I used enterprise units here, which so that gets you pretty close, but you go 13, 15, 17. So it is going up a little bit. But here in this example, again, 16, 15, and that could be rounding error as well, 15. So not a lot of difference until you get to 80, 85%. Where, for producers that want to get that higher coverage level, SCO is going to be a lot more affordable than an 85% revenue protection policy. So again, it's going to vary a little bit from county to county, but those are some general principles in terms of the cost and how it works with different coverage levels. Next, so why you're paying more? Well, it pays out a lot more. So we have some resources on Ag Manager crop insurance maps where we show the number of years since 2000 where these policies would have paid out. And the green ones on the map would have paid out less. The blue and red would have paid out more. So anywhere from every other year in some cases to about 1 out of 5 years. So, for these shallow losses, based on historic experience, you should expect to see fairly frequent payments in the long run. Next, again, the county trigger. So the liabilities are based on the producer's guarantee, but losses are based on county yields. So if you have your county expected yield is 50, you have actual yield of 40, that's a 20% yield decline. So if you assume there's no change in prices, the payout is going to be equivalent to about 6% of the producer's expected revenue. Now we do have, that issue though, are your yields close enough to what's happening with the county level for this to provide effective risk protection? So we do have maps of the county level expected yields or actual yields going back to 1990 on Ag Manager. So these are the 2024 expected yields for non-irrigated sorghum. We also have a yield correlation tool. And so this is for producers who have yield records. And what this do, all you have to do is say what county you're in, whether or not you have an irrigated, non-irrigated practice, and the crop. And if you can put in what yield, you don't have to go all the way back to 1990, but if you have it, we'll use it. And what that's going to do, if you enter your yield information, it's going to show how your yields compare to the RMA county yields. So we're going to show that visually in a graph. And we're also going to show the level of correlation. So it's not necessary that your yields are the same. That's not what correlation measures. It's when they change, do they change as much and in the same direction? So for you, you're going to want to see, if you want that higher risk protection, you're going to want to see a higher correlation. I would be surprised to see negative correlation. That means your county goes up and you go down. But this is one way to see how close you are to what's happening at the county level. And there's a link to that there. Next, and this is, I say, more of a caution to think about SCO policies as a long-term decision. A producer is making a larger investment in risk management. This is, there is the federal government's paying for part of the premium cost, so it's designed so the producer comes out ahead in the long run. It's not guaranteed, but it's a typical experience. But if you're choosing to go this route, there's quite a bit of variation in payouts over time, and you can go a couple years without a payout. So we have examples of that on Ag Manager, again, on the crop insurance maps page, where we look at what the ratio of actual to expected revenue was for counties going back to 2000. So this example is for non-irrigated soybeans in Washington County. So these years that were above 95%, those are years that expected actual revenue was at least 95% or over 100% of what was expected. And if you look at here and sort of these, it shows the different bands where ECO would trigger here. This is where SCO would trigger. And here is where your underlying policy would trigger. And so you can go a couple years without a payout and you'd be paying those larger premiums. Or you could be in a situation where you get sizable payments for a couple years in a row. So understanding, having that long-term perspective, I think is important, and being able to have a consistent risk management policy. Here's a similar map for Scott County. We have these for several counties on Ag Manager. If your county's not there, just ask me and we can run that for you. I've done that a couple of times. It's not a problem. Okay. Next, I want to show you, take a little bit of a look back to how SCO has performed relative to PLC and ARC from 2015 to 2022. This does have, history doesn't tell you what's going to happen in the future, but it does give us a good idea of how these policies work. What we did is we estimated your net SCO, ARC, and PLC payouts for each Kansas county from 2015 to 22. We assumed an underlying 75% revenue protection policy, trying to make ARC and SCO as comparable as possible. And then we separated counties into two groups, depending on whether the ARC yields are separated by irrigated or non-irrigated, or they're combined. So what we found, if you look at the average over the entire period, PLC paid out a lot more than ARC for wheat and sorghum, as well as for non-irrigated corn. ARC and PLC were similar for counties with combined corn yields, and ARC payouts were higher for irrigated corn and soybeans. As Robin said, there were no PLC payouts for soybeans. Now, this is the average, and a lot of producers are changing their strategies based on market conditions, and the differences over time are pretty interesting and instructive. ARC did generally have higher average payouts than SCO earlier in the study period, but SCO paid out much more during ARC in the 2022 drought, and that's really related to the prices, the different prices used to set for both of those policies, as well as the harvest price option that comes along with SCO. So I have a link to the full study there, but I've just pulled out a few graphs as an example. First, you have soybeans, irrigated versus non-irrigated. So you see For non-irrigated ARC and SCO, payouts were comparable. SCO was a little bit higher, but ARC was higher for those irrigated. And then for corn, again, these are the counties where FSA reports separate irrigated and non-irrigated yields for ARC. So for irrigated, ARC payouts were higher than PLC, but for non-irrigated, you had higher PLC payments than ARC. I think these are most interesting probably if you look at them over time. So here's our average ARC payments for those groups of counties with separate ARC yields reported. And you can see that payments were highest in the beginning, and that's when those guarantees were pretty high. You had, high revenue, high benchmark revenue coming in, or high benchmark prices coming into 2015. And then you had high payouts, relatively high payouts in 2022 when there was those large yield losses in so many counties. And I do want you, we're going to switch to SCO. I want you to look at the numbers on the y-axis here. So the peak was at $15 to $20 per acre. Now, what about SCO? So these are average payments for SCO for non-irrigated crops. So the county, so it's averaging what the hypothetical payments would be for every county in this group. So you can see, payments ranging is $20, averaging $20 an acre for wheat. There would have been some payouts in soybeans and relatively low payouts most years. Again, on average, if there was a large yield loss, there could have been some individual counties might have had it would have covered that. But you don't really see big payouts under SCO until 2022. And that average for non-irrigated soybeans would have been approaching $80 an acre. For sorghum, the average would have been $50. For corn, it was a little less, but about $35 an acre. And again, going into 2022, the RMA, the crop insurance prices for crops were higher. The benchmark prices were lower. You also had the harvest price option kick in. So, in those years, the SCO guarantee was effectively quite a bit higher than the ARC guarantee would have been. Check how I'm doing on time. Okay, got it, 10 minutes. So here we have corn prices. So what this chart does is it compares the FSA benchmark prices that goes into ARC. We have the reference price down here, and then you have your crop insurance price in gray, and in black, that is your crop insurance harvest price. So how those change over time is definitely related to payouts. So that, those benchmark prices, ARC prices were higher in 2015. And then, if you look at more recently, the crop insurance prices were higher. And now we're converging again. And that's really true for all crops to varying degrees. But, for corn, your benchmark price $4.85 and our current futures price about $4.78. They are super close. For the sake of time, I'm going to go pretty quickly here, but you can see the same broad trend for grain sorghum. Those crop insurance prices are pretty close to your ARC benchmark prices. They're getting closer for soybeans as well. The crop insurance prices are still higher. Wheat, so that's the pre-planning price. The crop insurance price was $7.30. That's actually quite a bit higher than the FSA benchmark price for wheat. And so next, I'm going to wrap up and take a look forward. So, it feels like we're in a new environment in terms of prices. So if you look at corn, projected price $4.77, $4.78. We're getting closer to 2019, 2021 projected prices. 21 and 22 harvest prices were higher than the projected price. Last year, the harvest price was lower than the projected price. So it does not to say we're going to continue heading into that direction, but we are, looks like we're heading into a lower price environment. And this plays out in our crop budgets that sort of generally narrower profit margins. So these are our the crop budgets we put out, and there's just averages. They kind of give an indication of the general conditions. So irrigated corn in Southwest Kansas, after paying for their direct expenses, so as well as like rent and capital cost, they're looking at about $100 profit per acre. So if you think about the 70% RP guarantee, that's pretty common. That'll cover your direct expenses, but not all of your indirect expenses. Where revenue protection plus SCO, it will cover nearly all of your expenses. Non-irrigated soybeans, this for Northeast Kansas, so the per acre profits are a little higher. So that 70% RP guarantee is going to be covering direct and indirect expenses. But the and if you would add on SCO or another high coverage policy, that's going to be covering that profit margin. But if I look back over the past year or two, it was like we comparatively, it was like we had higher profits those years. Thinking about higher coverage policies, do you want to protect this profit? Where we're heading now, it's sort of the same in some situations, but also will our expected revenue cover our expenses? There may be cases where you would need a higher coverage policy to cover expenses. And again, these are average. Every farm is different, but it gives an idea of the general trend. Next, I want to think about what the SCO versus ARC guarantee might look like. It's generally, I tested this with a couple counties, but it looks like the guarantee that both of these, the insurance or ARC are providing are going to be pretty similar in some counties. Under some outcomes, because of that, ARC's going to be a better value, but SCO and PLC, you have to pay in, but, like Robin talked about, PLC is going to provide higher protection in higher yield years when you see a drop in prices. Also with SCO, especially you have the harvest price option, that provides more drought protection, because in the case that you have a drought, yields go down, you have high prices, that guarantee is going to reset at those higher prices. Now there are some unknowns. The RMA yields relative to the FSA benchmark is probably going to vary county by county. RMA uses the harvest price. For ARC, it's the marketing year average. So those are going to come from different periods. Also, what crops you have base acres in could play a difference. That being said, I looked at ARC versus SCO for Nemaha County soybeans again. That max payout for ARC for those is about $58 an acre. A similar SCO policy about $67 per acre, assuming current futures prices. I plugged the same thing into Finney County. These weren't cherry picked. These were the counties and crops I used last year for my examples. ARC irrigated, maximum payout $96 an acre. SCO, similar policy, you're looking at about $108 per acre. So, a lot of factors go into these things, but broadly this year, those guarantees are going to be pretty comparable. So I did prepare a visual of what that protection looks like under different outcomes. Like Robin said, what we hope is that we have higher yields and prices than expected. We don't need insurance, but when things go wrong, you could have a situation where yields are high, but prices go down. Typically, if you have high production across the country, this can drive down prices. And this is where PLC is going to provide the most protection. If you have low yield and lower prices, that's going to be a tough year. So, in this year, ARC and SCO are likely to trigger unless it's an extremely shallow loss. But under this outcome, which we can't predict in advance, ARC is going to be a better value, typically. Last, you could have outcomes where you have a lower yield and a higher price than expected. This is most consistent with widespread drought years. PLC is not going to trigger under these conditions. SCO could trigger with the harvest price option and ultimately end up providing more protection in ARC under this outcome. So I'm going to wrap up here. I think with SCO, it's really a different, more intensive way to manage risk. And it could be attractive for producers who want to protect their profit margins, or even, if it's, margins are looking tight, make sure you can cover your expenses. And this is how you want to manage risk, and you're willing to pay an additional premium for that. If this is the route you want to take, having a long-term perspective is helpful. There are other options with other high coverage policies as well. And you need to be comfortable with what's going on with your operation and county yield trends. To wrap up for SCO and the ARC PLC decision, I think really is SCO the type of tool I want to use, and then thinking about the implications for ARC or PLC versus the other way around, since almost everyone that has base acres makes the ARC or PLC decision. But first of all, if you look at average historic payouts, the difference in the past between ARC and PLC was larger than what SCO would have been, but significant annual differences that relate to the guarantee. Again, SCO and ARC are likely to be similar this year unless we see a huge drop in markets in the next month. The long-term SCO plus PLC provide broader protection, but a producer has to pay in, while ARC can be a better value. My last point here, I've seen, producers, crop insurance agents come up with all sorts of creative combinations of policies, getting into optional units. But one thing I thought of, and this is not a recommendation, this is some, consideration to talk through with your insurance agent, but if you're a producer that wants to protect a larger share of your expected revenue, ARC plus ECO could be interesting this year, where, ARC is going to cover a similar space as SCO for free, and then you would have to pay to have SCO to cover shallow losses on top of that. With that, I'm going to wrap up. Looking forward to questions. I got a link to various resources here at the end as well. And, happy to ask questions now, or if somebody wants to follow up offline or ask for more information, I'm happy to do that as well. I think we were actually going to give the folks from FSA asked if they wanted to make some comments.
I messaged them and they said they're good. I probably, speaking for them, would say if you have not gone into your FSA office yet and elected ARC County or PLC, now would be the time to make that appointment and do that. So March 15th is coming up fast, and each county office has a lot of producers to serve. So there really is not an advantage to making that decision right at the deadline. Again, this marketing year is a long ways off yet, and making it now is probably the way to go. So, Jenny, I think most of the questions in the chat that pertain to what I was talking about, I did answer. One thing I did want to address a little bit, what if we're in a drought area here in Kansas and Iowa, Illinois, and some of those states are not? So your scenario, low prices and low local yields, that does definitely put us in a bind. Yes. There again, it's how low our price is, because ARC County would likely kick in the maximum payment if we had yield losses and low prices. But is that going to be bigger than what PLC might pay plus your SCO in that scenario? I don't know if you have any thoughts there, Jenny, but it would really depend how low prices actually went.
Yeah. So prices alone wouldn't usually trigger your underlying policy, but with SCO that can They're more, or especially ECO, where you're, covering even a higher share of your expected revenue.
But that would actually create the maximum ARC County payments quicker, because what happens if all of the US has a drought is all of a sudden you get low yields but higher prices, and sometimes those two can offset to where you don't have a revenue loss in ARC County.
I'm looking at some of the questions in the chat box. Any statistics on the numbers on the chart about increases in SCO, numbers of acres in irrigated versus dry land. I've had some of those charts in my update. I can throw in some charts in that when I do an update next week. Otherwise, you have to go to the RMA website.
Go ahead, Jenny.
Yep, that's all.
One question here, when are we going to have county yields for last year's crop? So what FSA is actually going to pay on, we won't know until next October. So say your soybean yield in Woodson County, we won't know that till next October as far as the 2023 crop. What we can estimate that on, so Farm Service Agency is supposed to be looking at crop insurance RMA county yields. Those will be released in June. And I typically use those to project what the ARC County payments might be. So look at our website in June. We will have some projections out there, but that is the soonest. We used to use the Nass County yields, but so much of them are combined, and so much of the ARC guarantees now have an irrigated and dry land yield component. So I just cannot use the USDA Nass County yields anymore to project those ARC County payments. Jenny, I don't know if you see any more there you want to answer.
Yeah, so somebody asked on the last bullet point, it said SCO, but you were talking about ECO. So I will revisit that. So let's say you're a producer, ARC and SCO are similar guarantee this year. So one option is to use ARC and then add SCO on top of that. So you're getting the benefits of ARC, but you're using SCO to provide more coverage. So that might be an attractive option for some farms. But it's something you really have to sit down with a crop insurance agent and study and make sure you're comfortable with.
Yeah, popcorning back to what I was just talking about, if you had an SCO policy, those will also get paid after the county yields are released in June for last year's crop. So that the timing of these payments is definitely something to think about too, because if your traditional crop insurance you have lost, you get that paid not long after the loss or after harvest. SCO, you got to wait till those county yields come out, and those are in June the following year. So, yep. One other thing, Luke had a good point in here. Your ARC benchmark yield being lower than your APH yield. Yeah, both of those have different adjustments. And Luke, like you say, there's a lot of different things you can do on your individual APH to try to boost that up a little bit and get your coverage higher. On the ARC County side, those low years, again, they put in 80% of the transitional yield as a plug. Those are also trend adjusted, but likely what you have for your own individual APH will be different than your ARC County yield guarantee. So that's something you can look at the tool and compares your APH against that ARC County benchmark.
Yeah, that's a good point. Got another question about ECO versus SCO. So the focus of the presentation was SCO. You can't use SCO if you pick ARC County, but you can still use ECO. So that's one way to buy higher coverage while still buy higher insurance coverage while still using ARC County. That was my main point there. And there's some links. Dan O'Brien shared a useful fact sheet, and there are some links to resources at the end of the presentation as well on ECO.